Stephanie Link, head of the investment solutions business, with Mike Shea, Tom Lee, John Bay. We are here for our webinar, a special webinar called Kicking the Tires. And we usually do this when we find wonderful guests that can help us navigate through the markets. And Tom has been around for many, many years, in fact, 25 years. We were just chatting about he's been #1 II as a strategist or an analyst since 1998, which is an amazing accomplishment. But we wanted to talk to Tom. Not only is he a frequent guest on TV, but we see and read all of his work, and it's really very insightful. And by the way, he's been spot on since March of last year. Well, I would say for a couple of years, because I've known him back in my Nuveen days. But we wanted to talk to him a bit about the economy and the markets and other important events. And so welcome, Tom, and thank you so much for joining us today.
Thanks. Yeah, Stephanie, great to be here and great to see you, and congrats on your new gig. It's not as new as it was, but yes.
Thank you. It's like, you know what, it's a small world. We know never to burn bridges, right? That we definitely know, and to keep friends.
Oh,
and
yes.
know we have been friends for many, many years. I want to start with, this is the key thing that I feel like I talk about all the time to investors on TV and to our colleagues, and Mike and I talk about it a lot as well. Peak growth, peak ISMs, peak PMIs, transitory inflation, and stubbornly low interest rates. Can you kind of put that into perspective for us and what your thoughts are? I know you've been a huge proponent of kind of reopen names, and so I just kind of, before we get into sectors of where we want to invest in, but just kind of big picture, where are we?
Yeah. Yeah, I'm glad to. And I might even be making a statement that sounds like I'm trying to complicate things, but I'm actually trying to identify something I'm found very curious. But you know, in terms of the reopening and escape velocity, you know, without question, and this week should confirm it, you know, the US is absolutely kicking butt, and I think we're going to see really strong growth. So to us, the surprise remains to the upside. And whether it's GDP or S&P earnings, which I think could hit, you know, 250, 240, 250 next year.
Wow.
But the rate of change is going to slow. Because for instance, let's say we post a 6% GDP each of the next 3 quarters, the rate of change just went to 0, you know, because we're just literally growing at the same rate. And this is where I think that we've had to rethink some things, but for the most part, it's certainly reflationary. Like, it's going to create reflation and pricing power, and people's wages go up. But the inflation impact, I think, is being very much distorted now because of the supply chain. And so I'm trying to see what's truly reflationary versus fake inflation.
Mm-hmm.
And our takeaway at the moment is that interest rates have overly discounted the actual reflation move. Mm-hmm. So as a weird threading the needle, I know we got a lot of criticism on this. I actually think interest rates have downside pressure right now, even though the economy is probably running a lot hotter than people realize. It sounds contradictory, but we'll be publishing some data. If you guys want to see some charts, I have some charts, but I believe strongly that we could be seeing upside to GDP prints, but decreasing pressure on CPI, which means rates should be falling.
Mm-hmm. Mm-hmm.
And that actually means that the cyclical epicenter trade is intact for demand-driven groups, such as I don't want to skip ahead, but that's a strange observation. So I actually think we're going to have great equity market, great economic data, but downside to interest rates.
So let me ask you a question on inflation. I agree with you. There are parts that are transitory. Obviously, commodities, certainly. Yeah. I kind of have a hard time on the wage side of things. I kind of have a hard time when I see, you know, JOLTS at 9.2 million. Yeah. CPI absolutely is, well, look, I mean, no, we all expected a hot print last week. We got 5%. I got it. It's the highest in 2008, but I know it was against nothing last year. So I get that, but I think my biggest not concerned, but just my biggest issue is that like wages and you can't get people, and you talk to companies, and you talk to companies, I talk to companies.
Yeah.
And so you've got like ISM services, you've got PMIs, you've got non-farm payrolls, all these numbers are saying higher wages. Then you talk to companies that say higher wages. So I'm just
Yeah.
sort of kind of, that's a big like sticking point for me to try to like just say
Sure.
it's transitory. So tell me like what, yeah, where are you
Yeah.
on that?
So I can cite 4 reasons, and then I have a chart that I haven't published in a long time, but I think it is related to this conversation. But the first reason is participation rate, because as you know, there's a lot of people. It's really 2 parts. Participation rate's low because, as you know, people are getting benefits now.
Yep.
So that is transitory to the extent that
Yep.
those will end. And there is also a transitory effect because there are people who, like, teen participation rates are really low right now. And hey, part of it is like, maybe they don't want to work, or their parents don't have childcare, so they got to watch the younger kids or whoever. The third factor that's transitory is, as you guys know, there's a lot of people who are fearful to go back. I even have a lot of clients. Now, it's true, older Americans have risk, but we have a lot of clients who are just still terrified to leave their house. And then the fourth reason is actually structural, and I'm going to share a screen. This is something is related to our demographic work, and I'll just share it with you. And it's just a PowerPoint.
No, it's great. You have great
But
stuff.
if you see this chart, this upper half, okay, the number of Americans that are between the age 35 and 60. And you can see that there's the number actually literally went to 0 in 2010. And it's actually 0 until 2022. And the reason it's happening is this chart on the bottom. See that there are a lot of baby boomers retiring right now. And the number of millennials, which is the input side, they're not really kicking in until 2022. So you actually have like this speed bump of like, we have a structural labor shortage, especially of skilled labor, right? Because what you're talking, like with JOLTS, you're talking some skilled labor, but that actually is a temporary effect because of the Gen X is such a small cohort in the middle. The real labor force is boomers versus millennials. And so millennials aren't replacing boomers in the skilled labor until 2022. So that's why I think this effect is going to disappear sometime next year. So again, I could be wrong, and I don't want to necessarily be declarative, but that would be the 4 reasons why I think it's transitory.
No, it's an important and commodities totally rolling over. That is transitory in your view, right?
Yes, because there was probably the equivalent of double ordering, and the equivalent of supply chain muck-ups. But I think some first order commodities like oil actually no one's really stockpiling oil. So I think oil is true signal, different than other commodities, different than what you're seeing with lumber and maybe what you're seeing with copper.
Yeah, copper too. So when do you think we're going to start to see an inflection on the downside on wage increases?
That's a great question. As you know, CPI weight is sort of it really weights healthcare and rents, and labor is indirect in it. And what's interesting is one of the reasons for healthcare. I could share another chart, Stephanie. Sorry, I'm just going to share this right now. This is a pie chart showing you the components of CPI. And you can see shelter is 33%. Oh, no, housing is 42%. And medical care is 9%. And food is 15. Oops, sorry, it just disappeared on me. I must have clicked on something. So CPI, so weight, and transportation is a big chunk too.
Yeah.
Healthcare has had a lot of inflationary pressures in the past, but those are decreasing. And housing is truly seeing inflationary pressures, and part of it is wages and lumber and home prices themselves. So that's, you know, if when that kicks into people's expectations, that does kind of get sticky for a while.
Mm-hmm.
You know, but as you know, rents aren't keeping up with home price, so that might protect it a bit. But it's a great question. I guess to me, the reason I guess I'm saying I don't, I think the downside factors might be emerging soon in other categories. And
Mm-hmm.
um,
It's sort of interesting because I hear and see rents are actually going higher, right? So
yeah,
it's like, not to belabor this whole inflation point, because like, look, there's parts that are transitory. I personally think there's parts that aren't, but I understand what you're saying. I think there's so many moving parts, right? I just wonder if the bond market at a 149 10-year is sort of kind of saying, yeah, we got it. It is transitory. And so you have maybe better than expected trend line growth, teeny bit more inflation, low interest rates. Isn't that Goldilocks? Isn't that Goldilocks for the market?
yeah, I think it's very much Goldilocks, very much Goldilocks.
Yeah.
Also, yeah, here's a chart I just think you might be interested. It's just to show you the relationship between change in CPI and the change in interest rates.
Yeah.
And oops, and here I think people are going to be surprised. CPI and interest rates are rarely in sync.
Mm-hmm. Mm-hmm.
Okay, so like you could actually have a really hot CPI and it doesn't affect interest rates, but look at break evens. See here, changes in break evens
Wow.
has a huge influence on rates, as you can see. So that's really more important, is because that's the market's just telling you, oh, it's really future inflation that affects the bond market. And same thing with GDP growth, though that actually does have influence on rates. But what I'm saying is, you can see in this line, but what I'm saying is, if GDP growth rates hit 6 and stay at 6, then the rate of change is going to 0. So that's downside pressure rates. If inflation break evens plateau at 2.5 or 3, then rate of change goes to 0. And so actually it's downside pressure to rates. So we might start to see downside pressure to rates just because of what you said earliest, which is peak growth may have already happened. Not the level of growth, but the rate of change.
The rate of change. And I get that. It's all about the rate of change. It's always incremental. I guess one last question before we go on to like where you want to be in the markets, but like where would you be wrong? Where is it inflation? Is it growth? Is it, you know what, like rates are already discounting a lot of all this stuff already? What is your surprise on the opposite side?
Yeah, well, where we're going to be wrong is really what's priced in terms of, in other words, because it's, you know, positioning, because what we're saying centrally is markets price in things and then the real thing happens. And so if they've overpriced it, then we undershoot. So there's, you know, as you know, the market can force the hand of the policymakers. So if the market gets panicked, nothing I say makes a difference, because it'll be the markets itself liquidating markets and forcing other policymakers to act. Like, so it could be the dollar, it could be commodities soaring because everyone believes there's inflation. It could be the break even starting to really stress other markets. So many ways we're wrong, and you know, we're wrong a lot. So we're just going to say future's uncertain. I'm only going to highlight what I think are the probabilities. So I don't want to sound like I actually know what's going to happen with rates. Rates are unpredictable.
We are all of us are wrong. That's why we stay humble, right? That's
yeah, that's right.
And you've been right more than wrong, and that's what we go. 500 batting averages, by the way, is really good. So, and you're
yeah, that's right. I'd be major league. I'd be getting those major league contracts then.
You sure would. All right, so let's talk about here. I really do want to talk about this. And so I get where you're thinking about rates, which makes sense why you have decided to go neutral to financials in your sector weightings, but you're still like in epicenter stock. So you're still reopen, which by definition to me also is a teeny bit cyclical versus like defensives, right? And even secular growth. So we'll get to secular growth in a minute, because I know you went to Fang. You're now like back into wanting to add to them. So let's just talk a little bit about where you want to be in this market.
Yes. So to us, if I had to say, okay, simplify, what would be our sort of factors to why we want to overweight something? One is that there has to be real demand growth developing. One that's not transitory, but a structural improvement. That's why reopening makes a lot of sense. The second is where there's going to be the potential for a lot of operating leverage.
Mhm.
And as you know, companies that are shut down and facing extinction, which we call unkillable, did things to survive. I think so many cyclical companies, or epicenter, or cyclical because there's some little almost interchangeable, are poised to deliver really big margin surprise. And the third thing is we want to be able to positively surprise the market. So it's a much more appealing to us to find groups that are underweight by institutions or are dismissed or viewed with a false skepticism. And that's what really attracts us last year to the epicenter. This year, we still like epicenter, but we're much more drawn to the first order commodity stories like the steels or the energies for that reason.
Why not copper? Because that's housing, that's EV. Is it just
Yes.
because it's already had a huge move?
Yes. In fact, I really should add copper. I just haven't looked at that market closely, and obviously it's a very super important commodity. Like you see, 'cause it literally goes into everything, and it's actually central to everything. I mean, it's going to be a big part of ESG,
Yeah.
big part of housing. It's a big part of the global trade recovery. It's a big part of aviation. It's autonomous driving, tech spend. It's part of everything. So it really should be. I just don't know the market that well. I don't know if the market's highly supplied or not, but you're right. Demand for copper should be going through the roof.
Hard to get copper out of the ground because there's not that many mines out there. So, but it's had a nice run. I mean, I look at some of these names and like Freeport. I mean, and I happen to own Freeport, so I'm a little biased, but it is up huge, and it's like, ooh. But I understand energy, and I think it's sort of interesting how energy in the S&P 500 is still at 3%, less than 3% of my weighting. And so for many years I haven't had to pay attention to it, and so now all of a sudden it's like, well, if I think it could go up, that's kind of sort of interesting. But it is still very, very small, and so technology is still very, very big. And so that brings me to technology, because you have downgraded financials and you've upgraded Fang and technology as well, Tom, or is it really more Fang quality tech?
It's probably more Fang at the moment, but only because like I'm structurally very bullish on tech. But a neutral on tech still means 10% in the next 6 months. So I think that still rewards people. Fang interests us. One of the reasons was really that Fang really got obliterated. And I just have a simple chart I could just share for a moment with your audience just to highlight this. But this is showing you the 6-month performance differential between Fang versus financials. And you can see that the underperformance of Fang versus financials was nearly the worst in 10 years.
Wow.
So you could see like it reversed back then. So my question is, should it be reversing today? That's one reason why we did the switch. And, I think there's been a big derating of multiples and then part of its rates. But, some of these Fangs are going to be very, like, as you said, sort of cyclical, because, it's kind of but they have pro-economic characteristics. So they're going to benefit from a reopening. So I just thought maybe their underperformance had overshot.
And the same thing for financials. They just overshot on the upside. Not that
that's right.
Yeah. Okay.
Yeah. I mean, like financials, that's why we're not underweight, because, they're still going to keep up with the market. And people who, for everything happening in the economy, there's a financial side of the ledger. It's just and capital markets will pick up in buybacks, but consumers have so much cash that they could do things that don't require credit consumption. So that's why it's more of a neutral.
My only thing about financials is that you get the next CCAR, right, at the end of this month. And so you're going to get probably companies announcing a little bit more in terms of capital allocation, buybacks, dividends, and that sort of additional buybacks and dividends and that sort of thing. And I don't know. I mean, to me, at like a 1 to 1.5 times book, it's not crazy egregious, but I get it. I mean, some of these stocks, I mean, I got I've got a couple of financials that are up 80% in the last year alone. So totally, totally. Meanwhile, Fang, it's up like 20% or 30%. Like, so I get it. I could. How about industrials? What do you think there? That's their days are done.
I'm watching this closely. Industrials and discretionary look similar to me in the sense that those were groups when people started to have some of their fear base, they were quite familiar with the names. So I think that they were very early recipients of sort of the rotation.
Mm-hmm.
And so I think there is some digestion taking place within the industrials. But I don't see a deterioration, and I don't think they face the risk that if, like, for instance, if rates go down, it's actually good for industrials because it's a cost of capital tailwind, and it's a financing tailwind, and it'll encourage mergers and other things that are quite good, and it also prolongs the expansion, which is quite good for industrial. So, like, to me, if I was just saying what I changed my view, and I think maybe rates, I just don't think have as much upside pressure. I was just thinking the most important shift within our original view would be that financials may have a headwind that was formerly a tailwind.
Gotcha. So let's talk a little bit about, I want to talk about a little bit about emerging markets, international and overseas, because then I want to get to COVID and Bitcoin, which I'm sure, I know you have a lot of great opinions, and unfortunately you had COVID. So I want to get your thoughts on that too. So anyhow, emerging markets. Oh no, I don't think actually you did have COVID. It was Rich Farr, but I want to talk to you about COVID because you've done a ton of work on that. But emerging markets, let's start first. And where was that a place that you think you want to be increasing allocations to?
Yeah, I think emerging markets and even Europe makes sense because, at the end of the day, Europe's going to have 80% or 85% of the return of the US over the cycle. And so there's a performance gap. Part of it is the US emerged sooner and is, I think, in a way, managed COVID a little better. And and without question, emerging markets is a beta trade to global expansion and to China. Both are actually in great shape. So I think EM makes a lot of sense. And again, EM, even though it is quite cyclical, still has relative performance to catch up to the US. But I think the key kind of is that the US is still where people need to start their central work and then make a relative bet from there.
Great. So on Europe, though, it's interesting because so we know that the European indices are like heavily focused on financials. And
Yes.
and you're not crazy about financials. So how do you get around that? Is it just that they're so much cheaper and they're so much more depressed?
Yeah, and that's a great question. I think part of it is, I think that the rate pressure, the rate delta might be towards upside in Europe, even if it's to the downside of the US, because as you know, US rates are so much higher than the rest of the world as well. And so I think there's chances that the percentage of bonds that have negative rates will drop this year.
Wow.
But it doesn't mean that US level of rates has to go up. So I think that could actually help Europe as well.
Any truth to, and I don't know if you know this, I saw a chart and I can't remember from who, but Japan, largest US Treasury holder and buyer. I had seen a chart a while ago that seasonally from May until August is when they buy. I don't know why that is exactly. I don't know if you've ever seen such a thing. Does that even make any sense? So it's not only like you're thinking rate of change has changed. Got it. Understood. But then all of a sudden you have like seasonal buying from the biggest buyer. Does that make any kind of sense to you? As to why our rates are so kind of every day they go down. And then not only that, but we got the Fed intervention. So that's kind of some stuff up too.
John Bay, my partner, might have more information, but the only thing that comes to mind, to tell you the truth, in Japan, because there'd only be two reasons for it. One is, do cohorts engage more during that period of time? Or is there a cash flow generation that's driving that? In Japan, as you know, that it's the Japanese housewives that do a lot of the trading, and maybe their kids have summer vacation. So Mrs. Watanabe is doing more bond buying. I know she's doing more FX trading. That's a possibility.
That's awesome.
Yeah. And Japan might have more tourist dollars. And so, the reserves are invested in treasuries? I don't know. That's a great question. But
Yeah.
and, we spent a lot of time with one of our Japanese clients. We're there a lot, but I don't know why.
I
don't know
know.
why
That's why I asked you that question, because you do have a lot of Japanese clients. I remember you telling me that, and you gave me all kinds of information a couple of years ago, back when I was at Nuveen. So anyhow, it is sort of interesting and a little bit of a conundrum, but we appreciate that. So tell me about COVID. So you do a ton of work on COVID every week. Are you going to stop doing COVID data because now that we're all good, or is it really still worrisome overseas and we still have to pay attention to it?
Yes, a great question. We're going to do we're going to continue to do surveillance around COVID because I bet you if we looked at the Fundstrat cloud capacity, half of it now is ingested COVID data. Whether it's vaccine or cases or deaths or county level information. And I think for the indefinite future, we're monitoring it. And I think it's because, as you know, COVID isn't really vanquished until cases go to zero, because in places like India, where it looked okay, suddenly had a big outbreak. And if mutations happen, there could be another wave. I don't think policymakers have to panic like they used to. So it does matter less that way. And, I just hope there's no change that is resulting in more viruses becoming transmissible to humans. I mean, that would be the more scary case, that somehow labs are leaking viruses or animal mutations because of climate change. There's a lot of reasons why, like, in 2019, before COVID came out, there was some MIT people urging the need to have surveillance around viruses. But it had to do with the solar minimum. It turns out that every time we get to a certain sun cycle, because of the way it's radiation's hitting the earth, humans have less vitamin D production. And so, like, if you look at like all the plagues, like Spanish flu, they all happened around the solar minimum. So I don't think there's another solar minimum for a long time. So I think if that was the reason why COVID happened, we're good.
I love that. That's awesome. Okay, I want to talk about Bitcoin. I don't understand it. Mike Shea and I talk about it all the time, and our heads are banging against the table. Understand why people do it. Heard Paul Tudor Jones today, which I thought was very interesting, to have a little bit exposure. You love it.
Yes. It's the best way to explain it, actually, there's no way to explain it in a minute, and then people will say that they suddenly change their minds. Because you're right, it actually doesn't make all that much sense. But the reason I think it can make sense is it has to be viewed through the eyes of someone who is not part of the traditional banking system. Okay. Bitcoin doesn't make sense if you're 65 and you got a lot of money in your account, because the banks treat you well. You can use money anywhere. But what percentage of the world is banked in such a concierge manner? Well, first of all, in the US, it's probably only 10% of people. So that's 90% of Americans don't have access to banks that way. The average bank in the US, if you look at economic cost, it costs people 4% of their annual income to be part of the financial system. And by the way, because 6% of all banking activity is suspicious, those people also get treated like criminals when they talk to the banks. But that's 3.5 weeks a year of income, right? People have to spend most of their, almost as much time paying the bank as they do state taxes. Outside the US, out of the 7 billion people, really more than 6 billion people are unbanked. And Bitcoin is the safest way for them to transmit and save money and store money. In fact, a lot of international wiring is using Bitcoin as a settlement layer. So it may not be Western Union, I wouldn't be surprised if they do, but a lot of when people transmit money overseas, those money exchangers use Bitcoin because it's safer and cheaper to transmit Bitcoin to the Philippines than it is to convert pesos to US dollar base layer, send it overseas, and then convert back. That's already 10% out of what you've already sent. Bitcoin costs you, whatever, $44 to do the transaction. Bitcoin's blockchain has never been hacked. It's now probably close to $10 trillion of transactions since inception. There's been not ever a single fraudulent entry on the entire blockchain. As you know, in that same period of time, banks have had many fraudulent errors, and someone pays for that. And Bitcoin today is already pretty liquid. I mean, there's more money moved on Bitcoin than PayPal, Discover, and Venmo combined. I mean, Bitcoin is, it already is moving a lot of money around today.
So you're not worried about the cybersecurity or security in general of Bitcoin?
It's definitely an issue. But if someone developed a quantum computer and they could break the blockchain, I would probably first direct that to JP Morgan.
Yeah.
And drain all the accounts there. And then, I mean, look at Swift. Do you remember some guy hacked central bank in Thailand or something, and they transmitted $250 million?
Yeah.
I mean, Swift, remember the error rate on a Swift transaction today is 11%. So almost 1 in 10 wire transfers people do have to be manually reviewed. None of Bitcoin transactions have ever been reviewed by human, and there's been 0 fault entries.
So it's sort of interesting because cybersecurity total addressable market is, they say it's going to be $880 billion by 2027. I think that's a farce. I think it actually is going to be double that. Just listening to what you're saying, right? It's over the time period, right? And so I know right now everyone's talking cybersecurity and everybody owns those stocks, but that's a total addressable market that I would, anytime I see a pullback in a couple of names that I own and and just that theme, I think, man, it just makes a heck of a lot of sense. And it's sad. It's sad, right? So we just hope that we can figure it all out, but there's a lot of money. Wait, what didn't, okay. So Brian Moynihan said that they spent $1 trillion on cybersecurity, security in general, up from 300 million when he took over in 2008. So it's growing. It's a growing business. I want to ask you one last thing about meme. I gotta ask you meme. I just gotta, because I don't understand it. That's another thing I don't understand. It's like Bitcoin and meme. I'm like, and by the way, I get asked about every day on CNBC. So I'm constantly doing work on it and homework on it. And where am I missing? What am I missing? But what do you make of it? You worry about it? It's a small piece of the market. It's most of them are only in the Russell 2000 indices. So most people don't have to pay attention unless that's your benchmark. But what do you make of it?
In short, I'm okay with meme investing, believe it or not. Because one, we have to keep in mind Tesla was the original meme stock. I mean, it had a valuation for a long time that was never justified by its contemporaneous numbers, but the sheer force of Elon Musk, plus his currency being so high, he was able to transform the company and raise a lot of liquidity. And now Tesla is, one of the most important stocks for the U.S. economy. But really, he was a meme stock. Because at least from what I gathered when I was at JP Morgan, almost everybody looked at Tesla as kind of like, oh my gosh, this thing's the biggest short. And as you know, for a long time, it was the most shorted stock, large cap out there.
Yeah.
So I think memes are symptomatic of there's definitely a new cohort. It's young people buying stocks, which I think is great. And then their ability to access derivatives, which is a mixed blessing, because that's both a curse and a benefit. I mean, it can be very scary, but options are safer than people doing outright shorting. But the thing we have to keep in mind is, millennials are inheriting $2 trillion a year from estates. So the power of meme investing, if that's the channel that young people are using, is actually only growing in time. Because I would guarantee today there's probably not even 100 billion of money allocated to meme trades. But it's getting a lot of firepower. You might have $5-6 trillion directed towards meme investing in the next few years. I know it's a weird observation. So this could really grow in influence.
It's a little scary though, when you don't invest on fundamentals. That's sort of kind of like when we come back and we're old, right? A little bit of gray hair. We kind of just nah, I get it.
You have to be anchored. You're 100% right.
Yeah.
Investor
I-
education would be a great solution,
Yes.
right?
I know. I've kept you 6 minutes after. I wanted to see if my colleague, Mr. Shea, wants to ask you a question. But I know he and I talk all the time, and we have the same kinds of questions. So
Yeah, I have one as a closer, Tom. What would, this is a kind of tough to quantify, but what do you think is the most underpriced risk in the market today?
Yeah, I think that's easy for me. I think one of the most underpriced risk is trust in the Fed. Because we always can say we sleep at night, don't fight the Fed. We know the Fed saved the economy many times, including March. And we had, a period of time when the Fed's role has always been controversial. So I don't mind people arguing with the Fed as long as the Fed never loses credibility. But the minute they lose credibility is the day we all have to worry, because then nothing can really save markets.
Wow, on that happy note, it's been a pleasure. It's been, no, look, I always say we have to worry about something, because well, the markets always worry about something. And when we don't worry is when I worry, right? Because then we become too complacent. So the list, I think, has grown in terms of what we worry about. But I don't know, at the end of the day, this is why I focus not on me and all on fundamentals. And I cannot tell you how much we appreciate you coming on. And I learned a ton. I always do. It's always such a joy to be on TV with you, but also to see you this way. And I can't wait till we see you in person. John, you too. You're amazing. Your team is amazing. What you've put together is incredible. So, so thank you so very, very much for your.
Yeah, it's definitely, we'd love to get together in person, in practical.
Yes,
not digital.
we're back in New York. We're back in New York on July 5th. So I will ping you, and we can maybe have some tea or something. So that'll be great. Thank you so much, guys. Okay,
Bye, guys.
guys. Okay, stay safe.
Take care.